What was sort of behind this huge decline? Was it the increase in real yields in the United States? Was it just profit taking after an incredible rally?
As ever, it's very difficult to pinpoint exactly, and it tends to be a combination of these factors, Lisa. But I think primarily it was profit-taking, and we were quite overbought in the short term. We'd see a massive move up in a very short period of time. And as ever, as you know in markets, you tend to see 2 or 3 steps forward and 1 step back. So, yeah, you're right. It was a more than $100 drop, minus 5.6% on the day. It was a very large drop indeed. And I think everybody was expecting a pullback, and I think we were expecting quite a sharp pullback. But when it came, 5.6% in one day is quite a significant pullback at the same time. So, but I think it's healthy. It's healthy for the gold market because it had become overbought and was coming a little bit, frothy in the short term, shall we say.
Mark, I'm struggling to understand the narrative behind gold right now. Is it an inflation hedge? Is it a hedge against potential risk-off feeling? Is it just sort of the balance of the portfolio instead of fixed income, given how low yields are? Or is it simply a matter of how much liquidity has been pumped into the system, the devaluation of fiat currencies, and gold sort of being the predominant alternative?
Yeah, it's a combination of all those again, and you've sort of hit the nail on the head with a few of them. But I do think that the last one is probably the most important because, there was quite significant financial, economic, geopolitical risks a few months ago at the start of the year before we came into the pandemic and the government lockdowns and the response and the response of the lockdowns and how that's really impacting our economies in a huge way. So yeah, we're already very vulnerable, and the scale of debt in the world was just astronomical, So the U.S. debt before we came into this crisis was around the 23 trillion mark, and we've gone up 3.5 trillion since February. So, that's huge. And I think people lose sight of the scale of what a trillion is. We used to talk about millions 20 years ago and then billions, 10, 15 years ago. Now we talk about trillions. And a trillion is one with 12 zeros after it, It's a very, very large number indeed. And I think people lose sight of that, even the financial experts and people like us who work in markets. Because you read it on Bloomberg, you read it in Reuters, and it's a dollar symbol with 1 and a T after it. But the gravity of 1 with 12 zeros is not understood by people. And we have massive government spending now, and deficit spending, because they're already hugely in debt. And we have the central banks basically electronically creating dollars with their keyboards and buying assets. And they're not just buying sovereign bonds, which is obviously needed during the last financial crisis, but they're buying junk bonds, they're buying stocks, they're buying ETFs, So the long-term ramifications is I think people are very concerned about it. But it very much depends. There's different investors with different motivations, but that is one of the primary motivations for most of our clients anyway.
Mark, what will it take to actually burst the gold bubble? And even if it does burst, given all the various factors at play that you were just talking about, will it actually go below $1,700?
It's possible, yeah. The resistance was at 1,700, 17. So as we know, the traders look at these technical levels and they can gravitate to these levels. So resistance was 1,700 to 1,800, and then we broke through there very rapidly. Indeed, it went up to well over $2,000. So, we tend to see resistance become support, and I think we'll see support at those levels. I don't think there is a bubble just yet in the gold market because most of the buying is there's no gold rush, Now that's the headline that's beloved of the headline writers is the gold rush. There is no gold rush because we're very busy, but most dealers around the world are very busy indeed. But it's from a very low base, and if you look at the amount of ownership in the world of retail investors, it's still very low. A lot of the money that's going in, and you see this with the ETF holdings, it's actually institutional money. So it is a combination of the risk, the safe haven, the hedging the devaluation of currencies, but it's also, I think, concerns obviously about negative interest rates, negative yields on bonds, and gold is actually a great source of returns in the long term, and people lose sight of that fact. It's done 10.5% per annum over the last 15 years.
Right. Mark.
Yeah.
Thank you so much.